everyone. Welcome to a special Cinco de Mayo, 5 of May edition of Taxes and Retirement Live. Here we go. I am Andy Panko, owner of Tenon Financial and admin/moderator of Taxes and Retirement. Thank you all for joining. So tonight's topic, we got a good one. As you can see here, the 4% rule. I'll be discussing the 4% rule tonight. Super interesting. Quite, I guess important, it's the right word, sort of fundamental kind of rule of thumb, litmus test, back of the envelope, math and figure used throughout the decumulation retirement planning, sort of spend down phase of retirement, financial planning. So we'll get into that, what it's good for, what it's bad for, when to use it, when not to use it, what assumptions are in it, etc. Before that, let me do the disclaimer. This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Thank you, which I am not. I'm just some guy on Facebook talking about tonight, the 4% rule. Super cool. So let me check comments here. Yep. Comments are working. Cool. Hola, everyone celebrating Cinco de Mayo. So quick Cinco de Mayo story. This was like 15 years ago, maybe. My wife and I went to Cancun, Mexico with another couple. Coincidentally, it was the first week of May. So we happened to be there during Cinco de Mayo, and we were out at some restaurant or whatever and asked the waitress, like, there wasn't much going on from what we saw. It looked like any other day. And so we asked her about Cinco de Mayo, and she's like, yeah, that's kind of an American thing only. I don't even know the history. I think it is a Mexico-specific holiday, but at least there, it's like, yeah, whatever. I don't know if it's Independence Day or something equivalent, but clearly the celebratory aspect of it is nothing in Mexico like we make it out to be here. Where here it's like a reason to eat nachos, drink Dos Equis and Coronas, and pretend it's a big thing. So, dad jokes for the evening. I will start you with, did you hear about the new restaurant called Karma? There's no menu. You get what you deserve. Served in a nice, hot, heaping plate of you get what you deserve. 2 giant windmills are out on a hilltop. One turns to the other and asks, what kind of music do you like? The other one says, I'm a really big metal fan. Or metal fan. I guess it depends where you put the emphasis. And finally, my mom was a radiologist. She met my dad when he came in for an x-ray. I wonder what she saw in him. Swallowed a nickel or something. I don't know. That's why he was there. So those are the dad jokes. So again, tonight, 4% rule. I'm excited. This will be a good one. Like I've been doing, we'll save questions to the end. I mean, feel free to pop them in or whatever. But when I'm done with the spiel, I will do questions. Here we go. Teresa Wood. Mexico won a battle against France on May 5th, Cinco de Mayo. But later lost. Not their actual Independence Day, was on tonight's local news. Okay. Oh, interesting. So maybe it's like they don't want to celebrate the fact that they ultimately lost, hence it's not a big deal. Whereas us, in America, we'll use an excuse for anything to eat and drink in the name of something. So thank you for that, Teresa. All right. So what is the 4% rule? Now, let me just jump right to it. So in 1994, there was a financial advisor named William or Bill Bengen who was trying to come up with a way of a safe withdrawal rate, if you will, like how much can be systematically taken out of a portfolio at the start of retirement and last you through retirement, about 30-ish years, what he was going for. Prior to then, again, 1994, there was no real methodical process or math or system in place for how much can be safely withdrawn from a portfolio. The kind of going logic at the time was, well, if your portfolio is returning on average 7% per year, let's say, then you can take out 7% per year, right? Because you're just basically taking out gains and that's it. Sounded good on paper, but there's something called sequence of return risk. Basically, I have other videos on this. I think we've done lives on this as well. It's not just the average return that matters, because life doesn't happen in an average, neat, pretty linear way. There's going to be good years, bad years, whatever in the markets. Sequence of return basically says if you have a string of bad years early on in your retirement nest egg decumulation, that's going to do much more damage to your portfolio, or at least you won't end up with as much, or possibly deplete it, as opposed to if you have a bunch of good years followed by bad years at the end. So the sequence or timing of when the returns matter. You can't just assume, okay, yes, I should get 7% on average. Let me take out 7% per year. Because what if your portfolio is down 25% the first year, 25% the next year? That would be bad. Not only is it down from dropping in price from your stocks and bonds, but you're also pulling money out as it's dropping. That can put a real big dent in it that you won't be able to recoup. So so Bengen said, let me look at historical data going all the way back to the 1920s, so predating the Great Depression, and said, let me run with different 30-year periods, starting in 1926, I think was the first year, for however many years, then 1927 for 30-something years, 28, 29, blah, blah, blah. So a bunch of rolling, 30-plus year periods all the way starting from mid-20s. And said, assuming, I got a slide for this, but basically, what percentage of withdrawals could I have taken out under any of those strings of 30 years and not have depleted the portfolio in 30 years, the average retirement at the time? And he ended up being slightly over 4%. So what does that mean? I'll get into an example. This is, why am I showing? I got an actual picture of it. So the findings were published in the some point in 1994, October 1994. Get my big head out of the way, of the Journal of Financial Planning. Here it is. It's like 10 pages long. It's publicly available. You can look it up online. Now, his research has since been come to be known and called the 4% rule. He didn't call it that. If you look at the title here, it's called Determining Withdrawal Rates Using Historical Data. The industry has since taken on the name, the colloquialism, the 4% rule. That wasn't Bengen's term. And he never intended it to be a rule. He was just using historical data to find, historically speaking, what level of withdrawal from a portfolio could be sustained throughout the period of about 30 years. And it so happened it was roughly 4%. So I'll get into the some of the details and assumptions. And for those of you who are interested, in November, there's a great podcast called Financial Advisor Success. It's kind of a hokey sounding name, but it is this podcast is hosted by Michael Kitces, who is hands down the thought leader and biggest brain in the financial advisor industry in terms of technical knowledge and things he's got his hand in, and super, super sharp guy with lots of great material. So he's got a weekly podcast called Financial Advisor Success. In November, he had Bill Bengen on to discuss the 4% rule. Really interesting. It's about an hour and a half long podcast, but really interesting. Talks about Bengen's background. He went to MIT for aerospace engineering or aeronautics engineering, worked at his family's beverage distribution place for a while. And then they sold that, and he decided to get into financial planning and did his research. So he's a legit guy, MIT, really sharp. He's not just some random dude who came up with some numbers. This was like real tested research. But the podcast was cool because it talks about how he came up with it, why he came up with it. And also what I thought was interesting is what are his thoughts about it now? So we'll save that to the end, meaning does 4% still hold up? Could it be lower? Or should it be lower? Should it be higher? Depends who you ask. Bengen himself says he thinks it could safely be higher now than 4%. You ask other folks in the industry and they'll say, no, it should be like 3%, if not even lower. So who knows? Nobody really knows, honestly, because we're all trying to sort of like use the past to kind of predict the future, which you'll see that disclaimer on anything. In the financial world, past returns do not guarantee future success or future returns or whatever. That holds true for this as well. But if you're interested in the podcast, it's www.kitces.com/198 for episode 198. Definitely give it a listen if you're even loosely familiar with the 4% rule and want to know more about it. So let's get into it. Just seeing what comments I have here now. Yeah, okay. Andy needs glasses like that. The big fat Bill Bengen glasses. Yeah, that would be cool. Thanks, Cody. I'll look for that in this gift giving season in my mailbox. Thanks. Okay. let me bring up the slides, and this will make more sense as I go through it here. So let me get my screen share. Thanks. I see Cody just posted a link to that, the podcast I just referenced. So let me get my screen share. Let me do this. Hold on a second here. Getting there. It's annoying when I do PowerPoint. There's like this dual screen that comes up, which is weird. Okay, I'll make that larger and I will share screen. Here we go. See if this works. And can I get myself up here? Yes, perfect. Okay. Here we go. Looks like we got it. So the 4% rules assumptions. It says you have a portfolio, and based on his research, the optimal mix of investments was 50% stocks, 50% bonds. Specifically, his research done in 1994, the stock portion was the S&P 500. It was large U.S. stocks only. It was large cap U.S. stocks, and the bonds were solely U.S. Treasury securities. I think Treasury notes, things that mature around 10 years. That was it. There's no international. There's no small cap stocks even. It was large U.S. stocks and U.S. Treasury bonds. So his research was 50-50, found to be the optimal mix, but it ends up actually anywhere from 50 to 75% stocks. All kind of gave the same result. So whether you use 60-40, 50-50, whatever, it's all within the realm of the research Bengen did. He said that you can withdraw no more than the prescribed amount. So his research was actually slightly over 4% was the safe withdrawal rate, but it's just kind of been dumbed down to 4% even throughout the industry. You can't take out 5, 6, 7, 8% every year. The history, the rule, the research does not support that. 4% is the one that works. It also assumes your withdrawals are only needed about 30 years, specifically in his research. Under every one of those scenarios, regardless which year you started, from 1920 something all the way through to when he did his research, under any 30-year period, the portfolio did not deplete faster than 33 years. So technically 33 was like the safe length, historically speaking. And he wanted, like I said, at least 30 because typical retirement was figured 30 years. Someone retires early 60s, live until your early 90s. That's your 30 years. The other thing, it does not account for taxes. Could be good, could be bad. This is just simply a gross portfolio withdrawal. So whether you have, all this money is in a hypothetical Roth portfolio and you're pulling out 40 grand, or all of it's in a hypothetical tax deferred portfolio where you're pulling out 40 grand, the research is the same. You're pulling out 40 grand. That's all that matters. Now, practically speaking, on the back end, taxes matter. So you want to know how much of it can you actually keep. That wasn't the point of the research. The research was how much can I take out of this portfolio, period. So disregard taxes. And this is sort of the big one. And this is why this rule, if you want to call it that, or these research findings is more accurate. It's not really a rule per se, is that it's using purely past scenarios, actual realized past strings of events, over rolling 30-year periods. But nonetheless, it's using past data and applying it on the assumption that the future will hopefully perform like one of these prior past periods has. Maybe it will, maybe it won't. No one knows for certain. So that is a big, valid sort of, I don't want to say concern, but kind of a challenge to the 4% rule. And I keep calling it 4% rule. Again, it's not a rule. It's research findings the industry has taken to calling it a rule. So I'll call it that just because. But that is sort of the big, this is just the past. It's not the future. 100% true. But there were some real nasty periods in that data set he used, including the Great Depression, including massive stagflation in the 70s. So, those scenarios were actually worse than the financial crisis and the dot-com crash, per his research. And I'll show you how the 4% rule would have held up over the last 30 years and 20 years, just for the fun of it. So I kind of did my own research, took a back test a little, because again, his original paper ended in 1994. That's when he published it. So we don't know, he's in the process of updating this data and the findings, but as of his original research, it stopped in 94. Okay, so let's go through an example. Basically says, whatever your starting portfolio value is, you can take out 4% of it in the first year. And then every year thereafter, you can increase that dollar amount of withdrawal by the amount of inflation that has happened. And so, or deflation. If there's deflation, then you would decrease the amount of your withdrawal. But assuming there's inflation every year, then your withdrawal amount is going to keep going up. So let's assume you retire at 65. You have a portfolio of $1 million, and this is just investable assets. Another big thing to keep in mind, this is not factoring in Social Security. So whatever your Social Security is, it is. Same thing with pension. Same thing with if you have an income annuity. Those are what they are. This is just in reference to your traditional investable assets, stock, bonds, mutual funds, whatever. Withdrawing from that in addition to whatever your other sources of income are. Again, whether it's pension, Social Security, rental income, side hustle business, whatever. This is just investable portfolio. So you start retirement with $1 million investable portfolio. The 4% rule says in the first year, you can take out $40,000. How did I do that? Well, here's the math. Simply take $1 million portfolio, multiply it by 4% or 0.04, and that's your $40,000 withdrawal. Make sense so far? So that's year one. Let's assume also during that year, there is 2% inflation. So now what's next year's withdrawal going to be? It's $40,800. How did I do that? It's simply the first year's $40,000 withdrawal increased by the amount of inflation there was that year, so 2%. So $40,000 times 1.02 equals the $40,800 second year withdrawal. And let's assume in the second year, there's 2.3% inflation, and this process repeats. So now the third year, the payment's going to be $40,800 plus that 2.3% inflation gets you to $41,738. Again, there's the math if you wanted to see. It's just taking the prior year's withdrawal or increased by the inflation that there was that year, and that then, wash, rinse, repeat. You keep doing this every year all the way down for, the rest of your life. And these are the withdrawal amounts that Bengen's research says, using historical actual data, a $1 million portfolio, you'd be able to withdraw these amounts every year, and increase them with inflation or decrease them with deflation. And you have a negligible chance of depleting your portfolio. Again, keeping in mind the assumptions, it's invested approximately half stock, half bonds. You withdraw no more than the 4%, whatever. So before I move on to my previous my actual back testing of the last 20 and 30 years, there's other things to keep in mind. So the findings, the research was that 4% is like the most conservative, of going back to 1926 again, or 25, or whenever it started, and looking at every rolling 30-something year period. In all those different 30-something year periods, the lowest or the worst scenario was that you can only withdraw 4% per year plus increase or decrease for inflation, deflation, and not deplete your portfolio. There were many 30-year periods in that history where it was much higher. It was 4.5%, 5%, 6% or whatever. This isn't saying this is like the average where you should be okay. This was the worst scenario, right? If you take no more than 4% per year with inflation adjustments, the history, including nasty markets like Great Depression, like stagflation in the 70s, show that 4% is safe, in that you statistically, based on the past, should not deplete your portfolio. So another criticism of the 4% rule is that 4% could actually be too low. More times than not, someone could take out much more than 4% per year and still be okay. Again, 4% is like the most conservative, the highest you can take out and still hopefully have enough portfolio for even the nastiest of 30-year scenarios, using history as the guide. So I'm just looking at some comments here. One was, so yes, Bengen's 50-50 stock to bond allocation was rebalanced every year, once a year at the end of each year, brought back to 50-50. Great question. I should have mentioned that before. I may have in the assumptions and glossed over it. Sorry, but yeah, good point. So that's the 4% rule. The math behind it, at least, and how it works, how you apply it. Now, it's not again, it's using the past to try to put some sort of reasonable guess to the future. And Bengen himself said, like, this isn't going to guarantee future results. It's just looking at the past. But the past, his data set did have some really bad strings of years. So this is pretty sound research. Now, I've seen this misused and abused and misunderstood, and people who try to discredit it will, I don't know if they knowingly consciously misrepresent it, or they don't fully understand it. But I've seen people do videos trying to discredit the 4% rule, saying, yeah, it works sometimes, but look, it'll deplete your portfolio in 15 years in this scenario. And I've seen one guy do videos on YouTube where, to him, or at least what he's showing, he's calling a pure stock portfolio, and he's running that through the 4% rule. And yes, that would have historically failed. Bengen's own research said stock allocations more than 75% are too much and potentially dangerous, and anything less than 50 is also bad because it's not enough growth. So that's why Bengen said 50 to 75. His research showed 50 to 75% stocks is a sweet spot. Anything more, too much risk. Anything less, not enough risk. Either extreme could be equally dangerous nonetheless, in leading to you depleting your portfolio faster than expected. So anyway, so there's a guy, not huge surprise. He's in the business purely of selling cash value life insurance products as a retirement cash flow tool. So he frequently will do things to try to discredit or make the withdrawal-based, a probability-based approach to retirement income, to make it look bad, because otherwise, look, insurance product guarantees, no downside, blah, blah, blah. So he did a video on the 4% rule where it was just flat out wrong. He was running analysis and projections and what ifs, assuming a pure stock portfolio and saying, look, the 4% rule fails here. Well, yeah, it failed. Bengen even said it failed. But this guy's misrepresenting it and calling it the 4% rule when it's not, to try to prove a point. And it's just, that stuff makes me angry. Anyway, lots of people misunderstand it and misapply it, knowingly or not. I don't know, but okay. I see some questions here about 4% rule going forward. I will definitely get to that because I think that's 100% worth visiting. This is cool. So Cannon asks, I'm wondering if the data set of 30 years began in 1990, I would believe the most conservative takeout would be significantly higher than 4%. Funny you should ask that, Cannon. Let's look at that. So I did my own testing on this. Let me walk you through this. So not coincidentally, starting in 1990, or in 1989, 1990, sorry. So 1990 to 2019. So this is 30 years. I assumed a 60-40 portfolio, and the 60% stock I assumed was S&P 500, just like Bengen used, but I'm using 60 instead of 40. And again, his research showed 60-40 or 50-50, insignificant differences. And for the 40% bonds, I'm not using just treasuries like Bengen did. I'm using the Bloomberg Barclays U.S. Aggregate Bond Index, which is part U.S. treasuries, part U.S. corporate bonds. I'm also assuming it's rebalanced at the end of every year or beginning of subsequent years. And what I also did is I'm stripping out 1% per year in fees / expenses. I don't know if Bengen's research did, but practically speaking, you can't invest directly in an index. An index is just a hypothetical reference of a basket of stocks or bonds. In order to actually invest in that, you need a fund company to create for you an investable product that tries to act like that hypothetical reference of a basket of stocks or bonds. So I'm whatever the total return was of this portfolio each year, I subtracted out 1%. I made it 1% lower to assume there's going to be some sort of fund fees, fund expense ratio, or if you work with an advisor, some sort of advisory fee. So I'm shaving 1% off the top. For inflation, each year, I simply use CPI, the base CPI, not CPI-W or U. It's just the headline CPI, Consumer Price Index. So what I did was started with $1 million portfolio in 1989. So 1990 was my first year of withdrawals. And I withdrew, what am I looking at? Oh, the blue is the annual withdrawal amount, and its axis is over here. So you can see $40,000. This was my first withdrawal, 40,000 exactly. And then every year, my withdrawals ticked up as inflation ticked up, such that by the end of 2019, my withdrawal was close to $80,000. Actually, a little over $80,000. This orangish yellow line, this is the total portfolio value, again, rebalanced every year, 60% S&P 500, 40% the Bloomberg Barclays aggregate, so treasuries and US corporate bonds, minus 1% per year in advisory fee and or fund expense fee. So the portfolio, to Cannon's question, yes, the 1990s were phenomenally good for the US stock market. You can see here from 94 to 2000, things just absolutely ripped. And I mean, rip in a good way. Gnarly, dude. So, 10 years in, even after taking out over 50 grand per year at that point, the portfolio went from $1 million up to about 2.4 million bucks at the end of 1990. Then the tech bubble burst and there's a few bad years, but guess what? The portfolio had run up so much by that point that the bursting, brought your portfolio down to only $1.9 million, 1.8 and change maybe. And then the first half, the early 2000s were good. Then there's a financial crisis, horrible time. The stocks went 50, 60% drop. But still, the portfolio was still in absolute terms quite high. It was 2.4 million bucks. So even with the 0809 crisis, it dropped back down to only 1.9. And then, as you know, from the financial crisis onward, it was just a massive rebound in asset prices, such that over the last 30 years, the 4% rule would have meant you started with a $1 million portfolio and ended up with like almost $3.7 million. Cannon, where'd you go? Yeah. So to answer your question, yes, 4% would have been grossly over conservative. What the actual percentage could have been, I don't know. I didn't run that. I mean, easily 4, 5, 6%. 5, 6, if not more percent per year. But just goes to show, like 4% is the worst case using historical data, right? In this case, it was grossly too conservative. Cannon. Now, so that this goes back to sequence of returns. The stringing together of bad returns is much more detrimental to a portfolio early on in your distribution phase than it is later on. Case in point here. Yes, there was one not good year right off the bat, right out of the gate, but then it was basically steadily upward, including massive upward gains in the late 90s. That's good. That's great sequence of returns if you're starting retirement. Let's look at bad sequence of returns. Here's another example. So I can only do 20 years because, 2019, we're only as far as we are in the future in the timeline of the world. But what I did here was, okay, let's now assume instead of starting in 1989, you're starting in 1999, just before the tech bubble burst. So really bad sequence of returns because the first few years are bad. And then a few years later, there's 0809. That's not good. So I applied the exact same logic as before, starting with $1 million portfolio, invested in the same 60-40 as before, rebalanced every year as before, stripped 1% right off the top as before for advisory fees or fund expense fees, and used the same CPI measure of inflation to increase our withdrawals every year. So let's look at this. Again, the orange line is your portfolio value, starts right at $1 million in 1990. And then boom, 3 bad years of stock returns. 2000, 2001, 2002 were losers for stock returns. And the blue lines are your withdrawals. The first year, file this over, $40,000 was your first year withdrawal, and then ticked up a little bit every year based on inflation. So at the end of 20 years, you were withdrawing about $60,000 a year. Now look at your portfolio. Let's just go back here. In this scenario, 20 years in, so where are we at? So by 2009, so 2010, so 20 years in, your portfolio that was $1 million is almost, it's over 2.2 million bucks, right? With doing this 4% withdrawal rule. 20 years in, you went from 1 million to 2.4 million or whatever I said, 2.2. Now you start retirement 10 years later, you start with the same $1 million, but 20 years in, your portfolio now is only, what is it, 620,000 bucks maybe. Sequence of returns is what happened. You're taking out the same 40,000 bucks and increasing each year with inflation, but you had really bad years of portfolio returns the first few years. that irreparably damaged your portfolio early on. Plus, you were taking out withdrawals every year, so you were kicking your portfolio while it was down. It's not going to be able to rebound from this point forward. Now, this still isn't the end of the world because, yes, you started with $1 million, portfolio's down to, let's just call it $600,000. Doesn't look good, but this was already 20 years elapsed. You still have 10 more years now, or I want to say only 10 years, but the 600 grand now, using 30 years as a sort of proxy, you only need this 60 grand to last you, the 600 grand to last you 10 more years. So as bad as this chart looks, 20 years have elapsed out of our 30-year sort of target time series here. So I still think going forward, we don't know what the future is going to hold. We know 2020 was a phenomenal year. So actually, other than there's a really bad, short and violent correction when the pandemic started, but as far as asset returns go, 2020 was a great year. Even the 60-40 portfolio was up like 20%, give or take. So this would have popped up a good amount. So at the end of 2020, I'm going to venture to say, your portfolio is back close to, let me do the math here, 60, 120. It was probably up about 80 grand, 120. It made 60, 70 grand this year. So yes, your portfolio would have ended up like here in 2020, let's say. So then now you have 9 more years to go. So anyway, so yes, your portfolio dropped a lot, but it still looks like it can quite plausibly hold up for 10 more years, even with withdrawals of 60 grand and more going forward. So this is kind of the best I can show for to pick up where Bengen left off. Because again, his data stopped. He did his research in 94. So I looked at the last 30 years, last 20 years, just to see what would happen. And this thing still holds up. Now starting in any data set, any projection that starts at the peak of the tech bubble, and so you're capturing the crash right off the bat, this is a bad scenario. I don't want to say this is as bad as the world's going to get, but this is a real bad start. So for it to still hold up fairly well here, I can say the 4% rule did what it was supposed to do, and it looks like it's going to work for this 30-year period. Quick side note, you'll often see, again, I hate ragging on people whose sole job it is to sell insurance, but you'll see in other Facebook groups, there's people who only sell, their only line of business is selling cash value life insurance as a retirement cash flow tool. Their projections, there's one that came up just recently in another group, was comparing the S&P 500 versus this hypothetical insurance product, what it would have done. And not coincidentally, they started at the worst possible start date you can choose for stock-based investments. So yes, from 1999 going forward, that insurance-based product would have returned a little more than the S&P alone would have. But if you look at any other starting point in time, the stock-based portfolio would almost certainly do better, if not crush the insurance-based projection. So data can always tell a story. You can massage, you can manipulate, you can fudge data to make it look, to show whatever scenario you want. Now, I didn't consciously choose 2020 and try to paint a picture. I just said, let me look back 30 years. So I did. And let me look back 20 years. So I did. It just so happens looking back 20 years starts right at the worst time possible, which actually, it paints a very interesting picture. Other thoughts on, really, that's it? That's all I got? I guess it is. Okay. Yeah, that is all I got. So let me stop my screen share and bring this window over. So questions about thoughts of the 4% rule going forward. So Bengen's own comments, and on that podcast interview that I shared and that Cody gave the link to, he thinks that the 4% rule going forward could actually be higher. Now, a lot of people say, well, bond returns aren't going to be as good going forward as they were in the past. Absolute nominal value of bond returns won't be as good going forward as they were in the past. And I agree with that, because bonds, 20, 30 years ago, there's much higher interest rates. So yes, coupon rates, interest rates were higher. And then the last few decades, there's been a fairly steady decline in interest rates over time. And the way bonds work is when interest rates decline, bond prices go up. So bond investments have had this huge tailwind behind them for a few decades, kind of not propping up, but sort of continually increasing their prices. Now going forward, interest rates are at rock bottom lows or close to it. There's not a lot more room for interest rates to further decline. I mean, they can go negative as they have in Japan and in parts of Europe, but still, and in absolute terms, there's not a lot of more room for interest rates to go down. The risk is asymmetric. There's much more room for rates to go up than go down. If and when rates go up, that's not going to bode well for bond prices. So I do believe bond nominal returns, by nominal, I just mean like the total percentage return of bonds going forward will be much more muted compared to in the past. So that's one of the points against the 4% rule. People say, well, the bond portion isn't going to do as well as it has historically. I think that's fair to say, nominally speaking. Now, why am I getting so hung up on the word nominal? Because nominal does not account for inflation. So yes, in the 70s and 80s, bond coupons were 10, 15%. The 10-year US Treasury was 17, 18%, I think, at one point. That was a nominal return, but inflation was as high, close to it, or even higher, such that the inflation-adjusted returns were still fairly small, a couple percent per year, maybe. And what you got to realize is inflation is kind of as important as the nominal returns themselves, especially when it comes to withdrawing money. So like in Bengen's 4% research, yes, obviously asset prices matter, but so do inflation, because inflation is what drives how much more you're taking out. So the worst scenario in Bengen's research wasn't the Great Depression, surprisingly. Now, yes, asset prices dropped. 61% was the drop in stock prices. Bonds were up about 10%. But there was actually deflation. So prices didn't go up. Prices went down about 16%. So yes, the portfolio got hurt. The asset side got hurt, but the withdrawals would have went down as well because things cost less because there's deflation. So the Great Depression actually wasn't the worst scenario in Bengen's research. It was what he called the Big Bang. It was stagflation of 1973, 1974. That was a double whammy because not only was there massive inflation such that people had to keep withdrawing more to keep up with the cost of daily life, so the withdrawals increased, but asset prices decreased as well. Stocks were down 37% in those 2 years, and bonds were up about 10%. So double doozy, assets came down, withdrawals went up. That's the most dangerous scenario per Bengen, per his research, and I agree with that. Asset returns are just one side of the equation. You have to look at inflation and how much you actually need to withdraw to live on. That's the other part of the equation. So where am I going with this? So going forward, yes, I do think the absolute nominal return of bonds will be much more muted compared to it was the last few decades, but there's not a lot of risk of inflation. Now, some people may be tisking and being like, you're wrong about that. But we're in a low inflationary environment now. There's a different Fed, monetary policy, banking policy, Federal Reserve actions have evolved since then. I don't think they'll let runaway inflation happen like it has, or at least they know better now the damage it can do, so they'll try better to prevent it. So many economists think there's really not a lot of massive inflation on the horizon. Other people have different opinions. The doomsday preppers and other folks who are sort of cynics to start with will think, no, there's going to be massive inflation, but it doesn't appear so, depending who you ask. So with that said, yes, bond returns will be lower, but withdrawals aren't going to ramp up as fast as they would have in prior periods. So with a low inflation environment where asset prices like stocks have been doing well, may continue, may not, Bengen's not that concerned in his mindset, and I sort of agree. It's not just asset returns you have to look at, it's your withdrawals. If inflation stays low, your withdrawals will stay low, so you don't need as much asset return. So that's sort of the counter argument to people who say the 4% rule is too high because asset returns will be lower going forward. The second part of that statement, probably true. Asset returns may be lower going forward, but so will withdrawals compared to historical withdrawals, simply because there's not a lot of inflation now, and there may not be for a while. So that's my thoughts about going forward. Is there anything else I wanted to say about this? I don't think so. All right, I'll leave it there. If things come to me, I will let you know. But otherwise, let's go to questions. What is the best way to validate if your company does or does what? Okay, so not 4% related, but what is the best way to validate if your company does or does not allow for penalty-free questions? I guess penalty-free withdrawals. Called Vanguard and they said company did not have a penalty. Company said there was a box would be checked on Form 1099. I guess you're talking about withdrawals, rollovers, whatever. Yes, depends. If you're doing a qualified rollover, there shouldn't be a tax or penalty on it, and that will be checked accordingly on the 1099-R. I guess that answers your question. Okay. Oh, David Fultz, thank you. Yes. So great question. Did the 4% rule incorporate international equities? No. Bengen's original research was purely, the stock portion was purely U.S. large cap stocks. Another reason why thanks for bringing this up. And he mentioned this in the podcast. Another reason why Bengen said the 4% rule could and should be higher is because a handful of years ago, he started playing around with folding in smaller U.S. stocks. And those, folding them into the data set did better for the 4% rule. I don't remember what the withdrawal was, but it was definitely higher than 4%. It's a riskier asset class, but historically larger returns over the long term. So if you add that in, that's another justification for maybe the 4% rule should be higher, because we all now have cheap, easy, and commoditized access to basically any asset class we want. You want a little large cap stock? Boom, easy to get. You want some small cap stock? Get it. You want some international? Click of a button, I can go get an ETF for 0.03% annual expense ratio and no trading fee. So anyway, international equities, no, his did not. You can fold those in as well. Now, honestly, that would, using historical data, that would probably hurt the results a little bit, is my guess, Dave Fultz, because compared to US returns, historically, international equities have not done as well. Going forward, I think it's prudent to have some international stock to help diversify. For example, 2000 and 2010, international stocks did better than US. Not by much, but they did better nonetheless. 2010 and 2020, completely different story. US stocks trounced international stocks. What's going to do better going forward? Damned if I know. But I think it is wise to diversify and still have some international exposure nonetheless. But no, Bengen's research should not include international. I suspect if it did, the results will be slightly lower. But if you folded in small cap US stocks, like Bengen later did, kind of on an ad hoc basis, the 4% withdrawal actually went up. Okay. Teresa Wood, looks like that podcast is directed to advisors. Yes, it is. So anything from Kitsis is directed towards advisors, but there is nonetheless lots of good general other kind of nerdy planning content. So if you just kind of sit and listen through the advisors type of stuff about building a practice and Bengen's history and his firm and things like that, there's a lot of good nuggets in there about the 4% rule. Okay, what else we got here? Ooh, interesting. Dave Fultz with a mind bender. What do you think of using required minimum distribution tables as a safe withdrawal rate? Yeah, what do I think about that? By definition, I don't want to say it would be impossible, but it would be darn near impossible to deplete a portfolio taking out only RMD tables, RMD amounts. So for example, RMDs now start on your own accounts, not inherited accounts, but your own accounts. Start when you're 72. Specifically, in the year you're 72, you have to take out 3.9% of the prior December's account balance, from your accounts. And that percentage ticks up a little bit up until you're, I forget the age. It terminates at like 50-something%. So by definition, you're never taking out more than 50% of your portfolio, even in the real late years in your 90s and hundreds. Now, theoretically, can you deplete it? Yes, because the RMDs are based off of December year-end value. So extreme example, you're 100 years old, your RMD is such that you have to take out 50% of whatever the December 31st value was. Let's assume your December 31st value was $100,000. That means I need to take out 50,000 this year because my RMD says so. Well, what if between December 31st and when I take it out, the portfolio drops 60%? Now there's only 40 grand left in my IRA. Well, guess what? My IRA, my RMD still says I need to take out 50 grand. Now, they won't make you take out more than what's in there, but you'll nonetheless have to take the balance down to zero at that point. So yes, you can technically deplete a portfolio that way. But if you're only taking RMDs every year, you're only taking out, a few percent per year, even in your 80s and early 90s. I don't have my table with me. I think it's only like 10%, give or take, is what you're taking out, 10% of the prior year balance. And the prior year balance always adjusts. So as your balance declines over the years, so will your absolute value of RMD amount. Even though the percentage may tick up, the dollar amount may reduce because it's a percentage of a smaller portfolio. So I think that's too conservative, Dave Fultz. Yes, this will almost guarantee you will not deplete your portfolio if all you take is RMDs. But I think you're doing yourself a disservice and spending less than you should if that's the plan. Great question, though. June, what was the withdrawal from bonds when stock was down in the study? Oh, that's a good question. No, I don't. I think it was taken out evenly. So every year the portfolio started at a 50-50 mix. I don't remember if the withdrawal was taken out at the beginning or the end of the year, but I think the withdrawal was taken out just pro rata across whatever the portfolio was. And then the remainder was rebalanced back to 50-50, if I remember correctly. So no, it wasn't like sell what's up, keep what's down. I think he took out bits of both. Great question, June. But yes, this is another way to help minimize sequence of return. I know where you're going with this, June. When stocks are down, yes, you ideally don't want to sell them. You want to give them time to rebound, so you would pull from your bond portfolio. In practice, that's what most good advisors would recommend doing. So that, assuming that's not how Bengen's study did it, then yes, this would further help your portfolio longevity by taking from bonds when stocks are down and vice versa, as opposed to just taking evenly across the portfolio. Yes, his 50-50 was rebalanced every year back to 50-50. Does the rule assume or recommend from which investments withdrawals are taken? Does timing? Okay, so this goes back to June's question. I don't remember. It was one withdrawal per year. I honestly don't remember if it was the beginning or end of the year. It's something I should have recalled. But so yes, the timing would matter, and you can run this different ways. Like if you can go recreate his data if you want and take the payments out in the beginning versus take them at the end of the year. And yes, you will see there is a difference. My guess is taking out at the end of the year would make the portfolio last longer, because more times than not, portfolios go up in value. Stocks and bonds would have gone up in value. So taking at the end of the year would mean you're taking from a higher amount and leaving in more to grow. So that's my guess. I don't know what the study did, but all things equal, taking at the end should typically help. Good question. Does not using rolling 30-year periods over relatively short history overweight the middle years? Does not using rolling 30-year periods over relatively short history overweight the middle years? I'm not sure of the question. What is this? There's one 30-year period of data if you start in 1990. Oh, okay. Yes. So for me, Alan, this may be what you're asking. The analysis I did, yes, I happened to start at 1990. I didn't start at 89, 88, 87. I didn't run through all those iterations. Bengen will be. I think he's updating his findings, so he's going to do 30 years all the way up to whatever date he's going to publish it. But I'm not sure if that's what you're asking. What I did show is my 20-year period starting in 1999. That didn't do too well. The first 20 years. The next 10 years, we'll see what happens. Yeah, like Cody said, yeah. So the 4% rule is just gross distributions. Obviously, pulling out $40,000 from $1 million portfolio is good if it's Roth, because you'll get to keep all of it because there's no tax on it. Not nearly as good for your spending needs if you're pulling out 40 grand from a tax deferred account where all of it is taxable. Do you know what year of withdrawals equals 1 million? Bill, do you mean in Bengen's study which of the 30-year rolling periods was the worst, and that 4% was the max that could be taken out. That was starting in the early 70s, right before the stagflation. I don't remember the exact start year, but it was that. The stagflation scenario was definitely, the budget buster in this scenario, because not only were asset prices down a lot, but inflation was up a lot. So double whammy on portfolios and withdrawals. How many years prior to retirement do you need to reduce the risk of your portfolio? 5 years, 10 years. So interesting you ask. Now, the conventional thought process is you're in retirement, you need to, you don't have wages anymore, you don't have the human capital, using the ability to use your mind and body to generate income from wages. That's stopped unless you go back to work. But so people think I need to get more conservative. Not necessarily true. Now, to some extent, yes, but it's not like a retiree should be 100% cash or 100% bonds. Real good chance your retirement's going to last 30 years or more, potentially 40 years. That's a long time. That could be as long as the number of years you worked. With that said, you still need some growth. You still have a long time horizon. Now, yes, unlike in the working years where you're just letting your portfolio sit there and grow and you're adding to it, in your retirement years, not only are you not adding to it, but you're likely taking from it. So you do now need to be aware of bad years. Like when you're accumulating and saving, bad years are actually good, right? Because you could just pump more money in and you're buying at low prices so that when things rebound, you get all that growth. So bad years are actually great opportunities while you're still working, while you're still accumulating. Bad years are not great opportunities when you're in the drawdown stage of life and distributing, taking out of your portfolio. So you want and need some cash and or some bonds and or some other relatively safe and stable asset, so that when there are bad years and your stocks are, you don't want to be pulling from stocks when they're beaten up. You want to take from the cash, from the bonds, from whatever your other relatively safe and stable asset is to meet your income needs in those years. Give the stocks time to rebound, whether it's 6 months or a handful of years. They should hopefully come back at some point. That's why you want and need the relatively safe stuff. But you can't completely get rid of stocks because, again, you still have 20, 30, 40 years of life. So you do need some growth engine, and stocks are that growth engine. But you don't want to be forced to pull from stocks if and when they're having some nasty time. Yes. So, Alan, I guess you're referring to my 30-year. Yeah, 100%. That's one data set. Means nothing. All it means is what happened in that 30 years. Is it going to repeat itself? No, not to that same extent, or not exactly, at least. And that's what Bengen did. His data set was starting in 1926, going up through 1960. So he had 40 plus rolling 30-year periods, which isn't a monstrously large data set. I admit, I think Bengen would as well, but it's kind of the best we had. There really wasn't good sources of data pre-1920s because there weren't developed efficient markets, and there weren't good record and data keeping. So the data really wasn't there earlier to then. So he kind of did the best he could. But yes, I agree. The data is far from bulletproof. It is what it is, and it's only 40 something sets of 30-year data. There'll be a handful more now if you refresh it now, because we can go back to starting in 1990 as the most recent 30-year start date. So that'll add some data sets to Bengen's research. Where'd we go? Oh man, a lot of questions. Wow. Something that is very confusing to me is these calculations don't take into account the reality of RMDs for tax deferred accounts. So in this example, you can't just take 50,000 plus inflation, depending on if the value really does go to 3 million, for example, then withdraw would be higher, right? Like 4 to 5% of the new balance. I don't know the calculation. I don't think RMDs would really stop this, because again, the RMD rate is 3.9% in your first year when you're 72, and ticks up a little bit year by year. It gets up to like 8-9% when you're in your late 80s, I think. By that point, your withdrawals will be higher than 4% probably, because they start at 4% but go up a little every year with inflation. So depending on the sequence of returns and how well the markets do, sure, I guess it is possible your RMDs will end up being larger than your prescribed amount under the 4% rule. So it's possible. I don't think it would ruin it. I mean, like Dave Foltz asked before, if you take only RMDs and no more, the chance of you depleting your portfolio is I don't want to say none, but it's slim. It'd be hard to do. Another thing to keep in mind, I'm glad you kind of had this thought. The 4% rule is just, it's very, very basic back of the envelope. It should not be someone's, written in stone distribution plan. Could it be? Yeah. I mean, historically it worked, but will it going forward? I don't know. But it's at least, it's a litmus test. And what I use it for in practice, if someone comes to me, they have $1 million portfolio and says, I need to pull out $100,000 a year. That's the goal I want for retirement. I'm going to be like, that's a 10% withdrawal. Probably not going to happen. We need to rethink this. But if someone says I have $1 million portfolio, my goal is to take out about $50,000 a year. I can say, all right, it's within the realm of reasonable. Using the 4% rule as a real quick and dirty back of the envelope check, sanity check. Yeah, that's a 5% withdrawal. It's doable. It could be tight, but it's doable. So that's what I use it for. And that's the extent of it, other than just a super basic gut check of, is this even within the realm of feasible? This plans these people want and their spending needs. That's it, right? Above and beyond that, no, it's far from a science. Again, you can't use the past and say it will play itself out in the future. So therefore, this is science. It's not. It's just a quick sanity check. All right. How can you withdraw more than the previous year when the portfolio is less than the previous year? So you can withdraw whatever you want. The 4% rule says you start with $40,000, let's say, again, $1 million starting portfolio, and that'll go up a little bit every year with inflation. Yes, there will be years where your portfolio may drop between a combination of the amount you take out from your distribution and poor market returns. But per the 4% rule's historical findings, that's okay, because there will be a rebound. Maybe it's a year, maybe it's 2 years, whatever. The portfolio will rebound at least to some extent, such that yes, you're not just on this one-way road down, where it zeroes out and you run out of money. So that's how it's possible that so long as it's still properly invested and rebalanced, historically speaking, it did come back, even though withdrawals got larger while portfolios got smaller in some years. But yeah, in absolute dollars, the portfolio itself is never less than a withdrawal. But yes, the portfolio may be decreasing and your withdrawals increasing. I think that's what you're asking, June, and that's okay was okay historically per Bengen's findings. I may have answered this. When is the 4% rule insufficient for retirement planning? Always, most of the time, only for a few people with complex scenarios. Yeah, great question. Again, it's nothing more than back of the envelope litmus test. Alan, someone has $1 million portfolio, says they need to pull out $90,000 a year. That's dangerous, unless they only have a 10-year lifespan. Sure, right? Assuming the average 30-ish year retirement, I'd say no. You can't reasonably expect to be able to consistently pull out $90,000 a year plus inflation from $1 million portfolio. Could it happen? Sure. If there's a great run of market returns, possibly. Should you bank on it? Definitely not. So for me, it's just a real quick sanity check, and that's it. In short, you're drawing down principal. That's shown in the second chart where you had 3 bad years starting in 1999 and the value of portfolio drops and you were having to take money out. Maybe you didn't take out the full adjusted 4% if you can cut back your budget. Yep. So you can always take out less per Bengen's findings, but you can't take out more. Or maybe if you take out more in the early years, okay, but then you got to take out less in future years. He didn't get into that complexity. His was just, let me keep it simple. What percent could I start with at the beginning, increase for inflation, and be set, right? It wasn't this dynamic, pull out more, pull out less. And this is what I want to mention. There's lots of ways to distribute a portfolio, and no way is necessarily right. And this is what's frustrating to clients and planners alone. We're trying to predict the future. Like, to be honest about it, we're predicting the future. We're trying to predict, or I should say, make educated guesses about financial market returns, about tax legislation, about your spending needs, about inflation in general. We don't know what these things are. It doesn't mean we shouldn't try to guess and put some reasonable assumptions and projections around it, but who knows? We're predicting 30, 40 years. Things will change. Even the best created plan now will be outdated in the not too distant future. It's like a flight plan, kind of a cheesy analogy, but flights have to have a plan, where they're going to go, where they're going to turn, what elevation they're going to be at, whatever. Almost inevitably, plans change. Turbulence comes out of nowhere. There's other traffic, something else comes up, whatever. So the plan adjusts. Knowing that the way you get from A to B will be different than what you thought, it doesn't mean you don't bother to make a plan in the first place. You still do. You just realize the plan is going to need to adjust along the way as the inevitable happens. Retirement planning is the same thing. Now, I know it's not a comfortable answer to say that because you get one shot to do this and do it right. And I get that and fully appreciate it. But you have to realize, and this is more so for like the math-minded engineering folks who want to nail down a quantifiable, proven analysis, you just can't, right? You tell me exactly when you're going to die. Tell me exactly how much you're going to spend every year for the rest of your life. Tell me exactly what stock and bond markets will do. Tell me exactly when tax legislation will change and how, and I will give you a rock solid plan that will not deviate from what we predicted today, right? It's just not possible. Why am I ranting? Where am I going with this? Oh, so 4% rule is just one super dumbed down, back of the envelope way to start to think about how much you can withdraw. There's another one called guardrails or dynamic withdrawals. Whatever your portfolio is, let's say you take out 6% of it, right? But you set bounds. As long as your portfolio value stays within that bounds, you can still take out 6%. If and when your portfolio drops, like you have some really bad stock years, then you're still taking out 6%, let's say, but it's of a smaller amount. So another way to think about it is it's kind of like it's a fixed percentage, if you will, based on a variable portfolio amount. Whereas the 4% rule is kind of a fixed withdrawal based on a still a variable portfolio amount. So the dynamic withdrawal ensures you'll never run out of portfolio because as your portfolio goes down, your withdrawal amount goes down. Sounds good in theory, but some people don't want their spending in retirement to be completely dictated by the markets, right? If the market's down, I don't want to have to cut back. I want to live my life. Some people like that. Some people don't. Doesn't mean it's right or wrong. The other extreme of distribution planning is called the safety first approach, where basically at a super, super extreme, you take all the market risk out of your portfolio and shovel it off to an insurance company. So in effect, you take every dollar you have saved and essentially buy annuities. You guarantee yourself income payments for life, no variability. Market goes up, market goes down, doesn't matter. You're going to get your check for however much dollars every month for the rest of your life. Maybe some survivor benefit, whatever. Now, sounds good in the theory, but it's really expensive to do that. Pound for pound to get a certain amount of withdrawal, you got to fork over a lot of money because the insurance company's taking all the risk. You got to compensate them for that. That doesn't, that's not cheap. There's no free lunch. It costs a lot of money to get sizable, chunky, guaranteed payments from an annuity. So that's not the answer either for most people. You can't just buy a boatload of annuities with all your money because you're not going to have a lot of money probably. Plus, typically there's no inflation increases with annuities. So whatever you get today is going to be the same amount you're getting in 30, 40 years, which might not be good. All right, sorry, I'm taking up a lot of time here, rambling. What else do we got? What type of inflation assumptions are you currently running? So I personally do anything medical or long-term care, I assume goes up 5% per year indefinitely, starting today. All other expenses, I assume 2.5%. I think that's fairly common across the industry. Some people may do 2, some may do 3, but 2.5 is probably the average for non-medical expenses. I think 5 is quite fair. Arguably, maybe conservative for medical, but that's what I do. While it's interesting to talk about the 4% rule, we also need to remember that most people who retired during the Beng analysis years typically have pensions and other revenue sources and typically not as invested in the market. Yes and no. So remember what I said, that obviously it'd be great if the entirety of your expense needs were covered by Social Security and pension. Awesome. That's the ideal scenario I think any one of us would want. That aside, this isn't saying, this is purely whatever your portfolio is, here's how much you can withdraw. Whether you have $0 in pension or $1 million in pension, whatever, it's looking purely at your portfolio context. So in that sense, then versus now doesn't matter, Ken. And now maybe in a broader, as far as the research goes, maybe broader, generally speaking, yes, people may have had more total income because they had larger pensions then than they do now. But that aside, that doesn't impact the the findings and the numbers of the study. But yeah, interesting comment. Referencing the 2000 chart, most experts advise holding 2 to 3 years of cash in the market. In the case of market decline you showed, would you be able to run that chart but not having withdrawals begin for 2 to 3 years? I could. Will I? Probably not, honestly. But yes, the portfolio will not deplete as much. Whatever your withdrawals were, so 40,000, then 41, then 42, just add those amounts back into the portfolio. It's kind of basically that simple, if you will. The results aren't going to look much different than what I just verbally explained here. June, withdrawal rate is of 4% of the portfolio adjusted for inflation. So when the portfolio had a down year as shown by the orange line, the withdrawal for that year should be lower than the previous year, but the blue bars were increased regardless. When the portfolio's down, no, the withdrawal doesn't need to be lower. So here's the way to think about it. Once you set your initial withdrawal dollar amount, that's set purely off the day one portfolio value of $1 million in my example. So your first withdrawal is $40,000. From that point forward, under the research of the 4% rule and the findings it showed, the portfolio value has zero bearing on your withdrawals going forward, June. The only thing that changes the dollar amount of your withdrawals is inflation or deflation. Whatever your portfolio is doing, it's doing. Your withdrawals are not in any way directly impacted by that. I think that understanding that may answer your question. I see where you're coming from. It looks concerning. Portfolio's down. Why am I taking out more? Yes, but per the findings, they were two unrelated things. Once you set the original dollar amount of withdrawal, it's only inflation or deflation that changes it. Inflation-adjusted expenses are typically not flat during retirement. True, they're not. Again, it depends how granular you want to try to model it. You can come up with infinite combinations of, okay, inflation's 3% in 2022, 2.7 in 2023, 1.5, whatever. And yes, you can model to that level of precision if you want, but it's just, what's the metaphor I'm looking for? I think it's diminishing returns because you can drive yourself nuts trying to come up with every possible machination of what inflation may do. Now, yes, assuming a simple linear assumption is pretty basic, but we don't know that any other more granular assumptions are going to ultimately end up being any better. But if you want to stress and shock it, sure, you can play around, with good software, you can play around with whatever annual expense assumptions you want. If you have only 0.02% fees, can you start with 5% withdrawals instead of 4%? So the right way to think about it is, and I've seen this come up in other forums and groups, like my advisor charges 1% of assets, so that right off the bat takes my 4% withdrawal down to 3%. So that I'd say true, honestly. So the 4% rule is just simply gross distributions from the portfolio. If you have an advisor where you're paying 1%, then you have a 1% gross distribution from your portfolio. So yes, that right there does take your 4% down to 3% under Bengen's approach. So I think that answers your question. Now, no, it doesn't. So if your fees are only 0 or close to it instead of 1, no, that doesn't mean you can take out 5% because it's the gross distribution that Bengen looked at, and that was 4%. So that would be inclusive of fees, if you will. Okay, yeah, so Cannon, that was responding to June's question, right? So what does one do to mitigate sequence of return risk? Have a cash cushion. When there are, it doesn't need to be just cash. I mean, cash is ideal, but cash earns nothing. So that's kind of like the price you pay for 100% guarantee and stability of principal. Could also be some bonds, but relatively safe and stable bonds, not long-term bonds whose prices are going to whip around a lot as interest rates move, not riskier, lower credit quality bonds like emerging market governments or things like that. Cash is a perfect tool because cash will never go down in value. Now, it may not keep up with inflation. The interest you earn may not outpace inflation. So there is still some net loss in cash in terms of buying power. So that's why you don't want to have too much cash on hand. But basically, you want an asset that's not too risky And so when stocks, the risky stuff, are down, you don't want to pull from them. You don't want to sell them. You want cash or bonds or something else relatively safe and stable to do, to meet your income needs for those years. Yeah. Eddie Martin, have cash value to support lifestyle for 2 or 3 years. Yeah, I guess that was in response to the other question. A buffer, a cash cushion. Cody Garrett, how about Nandy simulations? How about it? Yeah, I don't know. Question for Cody. 4% rule is about RMD, and as you say, it's just back of the envelope guideline. That's the big takeaway from tonight. 4% rule, just I like the term litmus test, back of the envelope, sanity check. It's good for that. Do not build your retirement plan around that and that solely. So next question may be, well, how do you build a retirement plan? And comes back to what I said before. It's impossible to know this stuff with certainty because we're trying to predict the future. Let's be honest about it. So you have to triangulate and do different things. 4% rule, good sanity check, right? If your plan and your spending needs pass the 4% rule, that's the first check. If they fail that miserably, you should probably stop right there. If they pass the 4% rule, that's kind of like the general gatekeeper. Then you look at other things. We do cash flow analysis. You actually project out year by year, look at all your comings and goings of cash. Monte Carlo is also a good tool. Again, it uses the past to try to predict the future, but in the absence of knowing what the future is actually going to do, it's better than nothing. Monte Carlo can run thousands of simulations and inherently capture sequence of return risk because it looks at statistically possible really good scenarios, really bad scenarios, and thousands of scenarios in between. And it'll run through and say, based on your expected expense needs and the portfolio you have and all these statistical projections of correlations and returns and what things may do and sequence of returns, what's the chance of you running out of portfolio by the time you reach, whatever your assumed age of death is? That's Monte Carlo. Another way to look at it is having an income floor from things like Social Security, pensions, or annuities, such that even because those things will never stop so long as you're alive. I say that with an asterisk, because people say, what if the pension implodes or whatever? And it's a possibility, but there's typically insurance systems behind most pensions, at least private pensions. So anyway, so if you build yourself a floor of Social Security and or pension and or annuity to cover at least your basic expenses, if and when your portfolio ever actually does deplete, you're not completely destitute because you'll still have guaranteed lifetime income to cover at least the basics. So that's another approach. So anyway, you put all these things together and kind of triangulate into a plan that makes sense. Does it hold up to the 4% rule? Does it hold up under Monte Carlo? Does your cash flow seem to make sense? Do you have some sort of decent income floor? This is how you create a retirement plan. There's no one single bulletproof, this is it, this plan works, you're golden. It doesn't work like that, unfortunately. Okay, if you're not near retirement, you have to inflate expected expenses to your retirement date. Yep, exactly. Looks like 2 more comments here. I use 3% non-medical and 7% for medical from Fidelity Study and run those inflation on my spreadsheet and guesstimate up to 95. Yeah, and that's possible. I'd say that's on the conservative end of. I don't think that's unreasonable. Like if you were to do 5% non-medical, 10% medical, I'd say that's unnecessarily conservative. This can definitely play itself out. I think it's probably on the higher end of the bell curve, but nonetheless, it's a possibility. Good to know. Okay. And looks like this is the final comment / question. Do you think it's better to have 50-50 stocks to bonds in traditional IRA because you have to withdraw RMD whether stocks are up or down? Impossible to say without knowing the rest of your assets, what's where. I'd see where you're coming from. Once you're of RMD age and you're forced to start taking money out, then yes, you want to keep in mind sequence of returns and you don't want to be forced to pull stocks out of your IRA. This is where it's hard because all this planning is kind of multifaceted. From a pure sequence of return risk, what you're saying makes a lot of sense, June. But from like a tax efficiency standpoint, it's generally better to have your tax deferred accounts be lower growth things like bonds, have your Roth and or regular brokerage accounts be higher growth things like equities. So you have to kind of weigh tax efficiency or asset location, it's called, with this sequence of return consideration when RMDs are upon you. Now, honestly, like we said a few times, RMDs are relatively small. And if and when your portfolio does decline, year over year, your dollar amount of RMD is going to go down as well. So I don't think you need to be massively concerned about RMDs, especially if you're taking out only RMDs. That kind of implies, you're already pretty good from a retirement income point of view. There's some people who are taking out 5, 6, 7, 8% of their IRAs simply because they have to, because that's their living expenses. If you're taking it out just because RMDs tell you have to, I don't think you have to worry that much about this, or at least not about running out of money, probably, if you're only taking out the RMDs. Okay. One more. What is this? Okay, so I guess we're done with 4% thing. If anyone else has any random questions, feel free to throw them in. I'll hang out a little longer here. Do you have a good book that you recommend for retirement? So a few. Now, the ones behind me actually I just picked because they're colorful and pretty. They're, they are finance related, but they're not really retirement books. There's a handful. It depends what you want to know. Some are more technical than others. Some are kind of fluffy. Some are too technical. Some focus more on softer side of things. There is Roger Whitney has a great book called Rock Your Retirement, I think. That's definitely a good one. Fairly high level, but still has some good technical matters in it. There's one called Control Your Retirement Destiny by Dana Anspach, Anspach. That's much more technical. There's actually like spreadsheet excerpts and stuff like that for cash flowing out and doing time value of money. That's a good one. What else do I do? Those were kind of the two big ones that I read that were retirement focused. I mean, I read boatloads of books, a lot of which were like technical sort of text type books. So I sort of pieced together retirement knowledge from all sorts of technical industry readings as opposed to general readings. But those two books I think are the good ones. Roger Whitney, Rock Retirement, I think it's called, or Rock Your Retirement. And then Dana Anspach, Anspach, Control Your Retirement Destiny, I think it's called. Okay, what else do we have? When your IRA is in a target date fund, is there a choice where to withdraw from, stock versus bonds? No, that's one of the big downsides with using target date retirement funds in the distribution stage of life. In the accumulation stage, they're phenomenal products. Not best for everyone, but for a vast majority of people, that's kind of all you need. Set it and forget it. The one fund gets you the proper allocations of stocks versus bonds and a little sprinkling of cash for your risk tolerance and or kind of stage of life. Once you get into retirement, the way these target date funds work is, so when you're young and you have 20, 30, 40 years to retirement, the allocations of stock will be high. It'll be like 90% stock. And as retirement approaches, they automatically rebalance. 80% stock, 70, blah, blah, blah. The way they typically work is once you hit retirement and then get a certain amount of years past it, these things terminate. Like Vanguard's, I think, terminate at 30% stock from there on out for the rest of your life, and 70% bonds and cash. So even then, they still have some stock component. That may or may not be enough stock for you. It all depends. That's why I'm saying they're not great. But the other bigger reason why they're not great is you have no control over whether you sell stocks or bonds. You just sell a slice of the fund. And along with that, you're selling prorated portions of the stock portion, the bond portion. You can't control which one you're taking from. So from a sequence of return perspective, they're not great. So they're not ideal for the decumulation stage of life. Great question. What else we got? Maestro, are you taking new clients? I'll assume this is for me. Yes, but I don't do limited engagement or hourly anymore. I had to drop that. I only do ongoing. Those that want and or need ongoing planning and investment management lumped in with it. Tax planning is included as well. You can check out my website if you're interested, teninfinancial.com, TENON financial.com. Services and fees are detailed right on there. Rock Your Retirement by Roger Whitney. Yes, thank you. That's the name of that book. Okay, I think that's it. What is this? After target fund and 401k, usually have a retirement fund one can select. Yeah, so same thing. retirement fund is basically just another pre-blended mix of stocks, versus bonds, and cash. Like the Vanguard target funds, they terminate out at like 30% stock and the rest is cash and bonds. I assume the retirement fund you're referring to, or sometimes called an income fund, is probably structured the same way. Some relatively small amount of stock and then the rest cash and bonds. Book recommendation from Alan Thomas. I'm reading How Much Can You Spend in Retirement by Wade Pfau. Okay, great. Thank you for that recommendation. Okay, that is it. Let me just see what's next week's topic. I don't even know. For those of you that are interested, what's today? Ooh, reverse mortgages. So special guest next week. Special guest Josh Blum, group member, friend of mine from the ether, from the virtual world. He works for Mutual of Omaha. He's a reverse mortgage specialist. He will be on to talk all about the ins and outs of reverse mortgages. Super sharp cat, straight shooter. He'll be able to get a great walkthrough of what the products are, how they work, when they might make sense, when they won't, when you should consider them, when you should not. So definitely looking forward to that. So next week, Josh Blum, all about reverse mortgages. Until then, I will see you around in the group. Have a good night.